The Essays of Warren Buffett, Lessons for Corporate America, is a book that was co-written by Warren Buffett and Lawrence Cunningham. It is a compilation of letters that Warren Buffett wrote to Berkshire Hathaway shareholders between 1965 and 2012. The book is a valuable resource for investors, business leaders, and anyone who is interested in learning more about Warren Buffett's philosophy of investing and business. The book is full of insights and lessons that can be applied to a wide range of situations. So please, do take your time to listen well and understand his concepts, especially for those who have not read the book. At the end of this video, we will be outlining the 8 most important messages Buffett was trying to pass. The book is divided into 5 parts. Part 1. In the prologue, Buffett discusses the importance of businesses having a long-term focus and being managed in the interests of their owners. He also emphasizes the importance of businesses having strong management teams and cultures. Part 2. The fundamentals of investing. In this part, Buffett discusses his investment philosophy, which is based on the idea of buying businesses that are undervalued by the market. He also discusses the importance of patience and discipline in investing. One of the key examples that Buffett uses to illustrate his investment philosophy is the case of American Express. In the early 1960s, American Express was facing a number of challenges. The company had been hit hard by the credit card scandal of 1962, and its stock price had fallen sharply. However, Buffett saw that American Express had a strong underlying business. The company had a loyal customer base, and its charge card business was still growing. Buffett believed that American Express was undervalued by the market, and he invested heavily in the company. Buffett's investment in American Express paid off handsomely. The company's stock price eventually recovered, and Buffett made a significant profit. This example illustrates the importance of buying businesses that are undervalued by the market. If you can find a business that is undervalued, you have a good chance of making a profit over the long term. Another key lesson that Buffett teaches in this section is the importance of patience and discipline in investing. He argues that it is important to be patient and not to panic when the market is volatile. He also argues that it is important to be disciplined and to stick to your investment strategy. Buffett's advice on patience and discipline is based on his own experience as an investor. He has seen many investors who have made the mistake of panic selling when the market is down. These investors have often lost money because they sold their investments at a loss. Buffett believes that it is important to stay calm and to focus on the long term when the market is volatile. This section is a valuable resource for investors who are looking for a long-term investment philosophy. Buffett's advice on buying undervalued businesses and on being patient and disciplined is sound and has been proven successful over the long term. Here are some other examples that Buffett uses to illustrate his investment philosophy here. The case of GEICO. Buffett bought a large stake in GEICO in the early 1970s. It was a small insurance company at the time, but Buffett saw that it had a strong business model and a loyal customer base. His investments paid off handsomely, and the company is now one of the largest insurance companies in the world. The case of Coca-Cola. Buffett has been a long-term investor in Coca-Cola. He believes that Coca-Cola is a great business because it has a strong brand, a loyal customer base, and a global reach. His investment in Coca-Cola has also paid off handsomely. These are just a few examples of the many businesses that he has invested in over the years. Buffett's investment philosophy has been very successful, and his advice on buying undervalued businesses and on being patient and disciplined is sound and has been proven successful over the long term. Part 3. Valuation and accounting. In this part, Buffett discusses the importance of understanding valuation and accounting principles when investing. He also discusses the importance of avoiding accounting gimmicks and fraud. One of the key examples that Buffett uses to illustrate the importance of understanding valuation principles is the case of Salomon Brothers. In the early 1990s, Salomon Brothers was one of the largest investment banks in the world. However, the company was also engaged in a number of questionable accounting practices. These practices eventually led to the resignation of the company's CEO, and Salomon Brothers was fined by the Securities and Exchange Commission. Buffett argues that investors should be aware of the risks associated with companies that engage in questionable accounting practices. He also argues that investors should be able to understand the valuation principles that are used to value a company's stock. Another key lesson that Buffett teaches in this section is the importance of avoiding accounting gimmicks and fraud. He argues that investors should be skeptical of companies that report earnings that seem too good to be true. He also argues that investors should be aware of the red flags that indicate that a company may be engaged in accounting fraud. Buffett's advice on valuation and accounting is based on his own experience as an investor. He has seen many investors who have lost money because they invested in companies that were engaging in questionable accounting practices. He believes that it is important to be aware of the risks associated with these companies and to avoid them. This section is a valuable resource for investors who are looking to understand valuation and accounting principles. Buffett's advice on these topics is sound and has been proven successful over the long term. Here are some other examples that he uses to illustrate the importance of understanding valuation and accounting principles in this section. The case of Enron. Enron was one of the largest energy companies in the world in the early 2000s. However, the company was also engaged in a number of accounting fraud schemes. These schemes eventually led to the bankruptcy of Enron, and many investors lost a lot of money. The case of WorldCom. WorldCom was one of the largest telecommunications companies in the world in the early 2000s. However, the company was also engaged in a number of accounting fraud schemes. These schemes eventually led to the bankruptcy of WorldCom, and many investors lost a lot of money. These are just a few examples of the many companies that have been involved in accounting fraud. Buffett's advice on valuation and accounting is sound and can help investors avoid these companies. Part 4. Corporate governance. In this part, Buffett discusses the importance of good corporate governance. He argues that companies with good corporate governance are more likely to be successful in the long run. One of the key examples that Buffett uses to illustrate the importance of good corporate governance is the case of Berkshire Hathaway. Berkshire Hathaway is a holding company that owns a variety of businesses. Buffett has been the CEO of Berkshire Hathaway since 1965, and he has overseen the company's transformation into one of the most successful companies in the world. Buffett argues that the success of Berkshire Hathaway is due in part to its good corporate governance. He has put in place a number of policies and procedures that ensure that the company is managed in the interests of its shareholders. These policies include having a board of directors that is independent of management, having a clear succession plan, and having a culture of transparency and accountability. Another key lesson that he teaches in this section is the importance of having a strong management team. He argues that a good management team is essential for the success of any company. He also argues that investors should be careful about investing in companies that have weak management teams. Buffett's advice on corporate governance and management is based on his own experience as an investor and business leader. He has seen many companies that have failed because they had poor corporate governance or weak management teams. Buffett believes that it is important to invest in companies that have good corporate governance and strong management teams. This section is a valuable resource for investors and business leaders. Buffett's advice on corporate governance and management is sound and has been proven successful over the long term. Here are some other examples that Buffett uses to illustrate the importance of good corporate governance here. The case of Enron. Enron was one of the largest energy companies in the world in the early 2000s. However, the company's corporate governance was poor. The board of directors was not independent of management, and there was a culture of secrecy and deception. These factors contributed to the collapse of Enron. The case of WorldCom. WorldCom was one of the largest telecommunications companies in the world in the early 2000s. However, the company's corporate governance was also poor. The board of directors was not independent of management, and there was a culture of secrecy and deception. These factors contributed to the collapse of WorldCom. These are just a few examples of the many companies that have failed because of poor corporate governance. Buffett's advice on corporate governance is sound and can help investors avoid these companies. Part 5. Advice to business leaders. In this part, Buffett offers advice to business leaders. He emphasizes the importance of businesses having a long-term focus. being managed in the interests of their owners, and having strong cultures. One of the key lessons that Buffett teaches in this section is the importance of having a long-term focus. He argues that businesses that focus on the long term are more likely to be successful than businesses that focus on the short term. He also argues that businesses should not be managed for the benefit of their managers or their shareholders, but for the benefit of their owners. Another key lesson that Buffett teaches in this section is the importance of having a strong culture. He argues that a strong culture is essential for the success of any business. He also argues that businesses should create a culture that emphasizes honesty, integrity, and hard work. He has seen many businesses that have failed because they did not have a long-term focus or a strong culture. Buffett believes that it is important for business leaders to create businesses that are built to last. Here are some other examples that Buffett used to illustrate the importance of having a long-term focus and a strong culture. The case of Coca-Cola. Coca-Cola is a company that has been in business for over 100 years. The company has a strong culture that emphasizes honesty, integrity, and hard work. This culture has helped Coca-Cola to be successful for many years. The case of Southwest Airlines. Southwest Airlines is a company that has been in business for over 40 years. The company has a long-term focus and a strong culture that emphasizes customer service. This culture has helped Southwest Airlines to be successful for many years. Buffett's advice to business leaders is sound and can help businesses be successful for many years to come. Here are some of the key lessons that can be learned from the book. 1. The importance of buying businesses that are undervalued by the market. 2. The importance of patience and discipline in investing. 3. The importance of understanding valuation and accounting principles. 4. The importance of avoiding accounting gimmicks and fraud. 5. The importance of good corporate governance. 6. The importance of businesses having a long-term focus. 7. The importance of being managed in the interests of their owners. 8. The importance of having strong cultures. If this video is of any value to you, please hit the subscribe button and turn on the notification button. Thanks for watching.